This is Market Pulse by Faster Forward at Northern Trust Asset Servicing. My name is Marc Mallett, and I'm the Chief Strategy Officer for Asset Servicing at Northern Trust. Today, I'll be joined by Gary Paulin. Welcome, Gary.
Thank you, Mark. Good to be here.
Gary, you last appeared on Faster Forward, and that was released in February, but you've never appeared on Market Pulse.
Never invited.
Well, there's a first time for everything.
Yeah.
So would you be able to give our audience your background and what the areas that you're focused on?
Sure. So a recap for those that don't know. I came to Northern Trust in 2016 through an acquisition of a research brokerage that Northern Trust bought way back when. And back in my early days, I was a research strategist, and actually founded that business with Guy Gibson, who runs our capital markets. We joined 2016. I ran brokerage co-ran brokerage for a time, and then we identified an opportunity to build a business called Outsourced Trading, which is now called Integrated Trading Solutions. We built that grew like a weed with one client and $500 million under execution. It's now close to 100 clients and $500 billion of funds under execution. So that's growing very well. A couple of years ago, Pete Cherowich pulled me aside and said, "Gary, right, what's the next gap that you can go after and try and fill?" I realized that there was a few gaps, a few opportunities. I perhaps didn't have the domain expertise to fill those gaps, but there was one other gap that I did have some domain expertise to fill, and that was we recognized a lot of the decision rights our clients on our client side were concentrating in CIOs and CEOs, and yet we didn't really have a lot of relationship capital with those personas. So the idea was for me to try and build that connective tissue, exercise that muscle, and interface that relationship. And that's what I did. And the way I do that is, obviously I've got some old legacy contacts in that world, but I write a note, a weekender, and which I send out on the weekend.
I read it on a weekly basis.
That's good. You and my mother, you're the only two. But it's the idea behind it is it keeps me relevant. It keeps me up to speed with what's happening. It gives me currency to sit around the table with these folks and actually have a conversation where I might be able to add some value. What I realized was when sitting down with these folks, they tend to only have two big problems, right? And this is I'm being generalizing for effect, but the first big problem is their costs are too high, and their second big problem is their revenues are too low. We at Northern Trust have solutions that solve for the first of those with asset servicing, solves for cost, and of course we have solutions in asset management which solve for the revenue side of the equation as well. So I thought, well, perhaps it's an opportunity here if we've got the rare, scarce time of a CIO or a CEO, not just to position what we can do with asset servicing, but also think more broadly and think about what we can position as a total entity, and also provide them with asset management solutions as well. So that's where we are.
Well, there you go. That's a certainly interesting background, probably very different than many of our peers, right, at Northern Trust. And the writing that you do, like, so when you think about the markets every week, what are some of the guiding principles you have around investing and writing?
So when I think of what drives markets, and I come from an equities background, so forgive me if I talk more within that framing. But that's just bad habit. There's two things that drive price in markets. One's the numbers, and the other's the narrative. And I tend to focus more on the narrative than I do the numbers. And partly I do that because we set up our business at Aviate to really focus on the big ideas, recognizing that our clients can't take a view on every stock in the S&P, but nor should we reflect a view on every stock. What we're trying to do and we're trying to mimic what they're trying to do is identify where those big money-making opportunities are. Where's the big driver? If you get the first order mover right, second, third, and fourth derivatives will take care of themselves. So it's about identifying those big drivers of change and then finding ways to express it. So that's the second sort of framing idea. The third is to challenge consensus. And I don't do this to be painful. I do it because I just see in my own decision making, I need to be aware of the counterfactuals to be better informed in terms of making a good decision. And I always loved Charlie Munger's quote about earning the right to form an opinion. Right? You don't have the right to form an opinion until you know the counter-argument better than the person arguing it. So it's that searching for the counterfactual, not being caught in groupthink and really challenging consensus. And then the final thing that I try really hard, and this goes back to in a previous life, I trained as a lawyer, as a barrister, which I did for a very short time. But one of the lessons was to keep it simple. Less is more. And I realized why that is, and that is the reader wants very simple language because it takes away mental load, but it also...
The jargon.
Exactly. And it taps into their reward networks. Hence the reason we have so many acronyms. There's a reason why. Yeah. And it's not just the marketers. There is, we like very simple stories, very simple narratives because they resonate, we can understand them. And that's what we're trying to do with markets, with influencers, help people understand our message.
Yeah. So that's helpful. I wonder, we're approaching the end of the first quarter. Are you seeing any emerging themes, as we come out of the, end of last year? This is this is the first quarter end, for this year. Anything that you think is going to shape the narrative, for the rest of 2024?
So I tend not to try and get caught up in the short term, so quarter to quarter. But when I look beyond that, I think the big question is the question that's been needed to have been answered for some time. And everything is driven by rates, right? You get interest rates right, you get everything else right. And this isn't me saying this. This is a chap by the name of Mr. Warren Buffett who said what gravity is to the apple, interest rates are to valuation. So getting that right, you get a lot of other stuff right. And, of course, the key driver of interest rates is inflation. Now, I could sit here and give you a really articulate, persuasive argument for why I think we're going to see a re-acceleration within the price mechanism, within inflation. I could then probably give you a pretty decent go at explaining why we're going to get deflation, right, as well. Possibly stagflation, maybe even hyperinflation. The point is, I'm not sure it's inflation that's the issue as much as inflation volatility. So what does that mean? And this is a new thing.
Which we had basically stable inflation
exactly.
for 20 years.
Exactly. You've got to go back a long time, before even you and I have been working
thereabouts
to actually experience this. So I often talk about, you hear this terminology, new regime, and no one really understands what they mean by that. But I think it is this, you've got volatility in the pricing mechanism. Now, what does that mean for allocators? Well, it means a few things. There's the obvious, right, which we'll come on to. But the less obvious is they need to engender certain characteristics, both in their models, operating models, but also in their mindset. So the first is flexibility, right? They need to be far more flexible. If we're going to have volatility, we're going to have inter-asset dispersion. So you need to be more flexible in what assets you have and when you have them, and think about other assets as well. So flexibility is key. And that's a change element, right? And change is a bit of a contact sport. So you need people to buy in. So it's not just having the ability to be flexible in terms of the model, but also the mindset. So that's a big challenge. So the second thing, I think you're going to see a new emphasis placed on selling, right? The discipline of selling. And that's a new muscle, right? No one's, buy and hold and fixed income worked pretty well for 40 years up until a couple of years ago. Understanding the process and the discipline around selling, I think, is going to be something a lot of allocators seek more in their asset manager. So that's a key. You're going to hear a lot more about finding real returns. And I speak to a lot of allocators now who are trying to push away from benchmark or index-linked index peer returns to find more real returns, which makes sense in an inflationary environment. And then, of course, back to the key point about valuation. What it means for allocator is, you need higher compensatory yields in your fixed income market to withstand the volatility in the pricing mechanism, and secondly, lower starting valuations within your equity book. Now, the big question for everyone I talk to when I'm here in the US is, is the US overextended in terms of valuation?
Yep.
And And I think at the index level, a lot of people are concluding that perhaps it is. That said, I think there are pockets of value. Small caps. I know, we, Northern Trust, we think small caps are very interesting. I agree with that. I think that from a valuation perspective looks very interesting. But what I'm trying to get folks to focus on, mainly because I live there, is to look beyond this region to some other areas of the world where there is real valuation starting to emerge. Places like the UK, places like Japan still, places like Europe, Korea, and indeed China, which is a bit contrarian. But those are the sorts of things that I think folks are starting to question. And in the spirit of identifying the counterfactual, I think that's one counterfactual that needs to be explored.
And then, Gary, are there any sort of specific sectors or themes that you're focused on, going throughout you mentioned, some of the different regions, or anything within those that you think are going to have an impact on the balance of the year, or I suppose, even further out?
So let's be really contrarian for the sake of entertainment purposes.
Sake of good conversation.
Yeah. So I think China's really interesting. It's the market we all love to hate at the moment for a lot of well-known reasons. And when I go back to thinking about allocations and thinking about the risk around allocation, risk can come from what you don't own as much as it can from what you do own. And very few people own or have much exposure to China. Now, if you're extremely underweight or short, is the parlance of a hedge fund, if you're very underweight a stock or a sector or a region, you almost need to identify net new negatives to justify that position, in the absence of which the safer bet could just be sort of moving that to neutral. And that mean reversion, if you like, can be quite a powerful driver of price action in and of itself. So I'm always sort of observant of these setups, and I think we're in a setup now. So let's go to the news flow. And the news flow has changed, right? There are still negatives, but they're not incrementally worse. And if you just break down sort of the three key areas, you've got property, which is where the vast majority of their collateral exists. And remembering the Chinese did try and slow that down. This was intended by the Chinese government. There is change in rhetoric insofar they no longer talk about property is for living, not for speculating. That's been removed from official communications. Buying limits have been removed in some areas. They're talking about improving funding to certain projects. So that's change. It may not end up being a positive, may not lead to growth, but it removes a negative. So that's the first thing. The second area of growth development in any economy is what the entrepreneur is business origination. And of course, they got, they were quietened for a little bit. You didn't see much of them. Jack Ma, didn't see him for a while. Well, he's back. Jack's back. And he's buying his own shares in Alibaba, which I think is a powerful signal. And then the third thing is the stock market, which is looking increasingly like, I should have said this before about valuation. Valuation's only so good if there's a catalyst, right? You can, ice cubes can keep melting until there's nothing left. So there needs to be a catalyst. And one of the catalysts we're seeing emerging in lots of regions is when you invest in these countries like China, Korea, the UK, and Japan particularly, you're investing alongside vested interest. And that vested interest is the government, who want their stock markets up for a number of different reasons. China want their stock market up. Why? Because it's a visible market proxy of confidence, right? It could have wealth effects. And so they're doing lots of things, particularly around incentivizing state-owned enterprises and linking KPIs to share market performance, these sorts of things, which is really, really, I think, interesting and bears watching closely given the underweight. And so I fear that, those that don't own China, it could become a risk factor for all the wrong reasons. So that's one area which is quite contrarian.
So would you, like summarize what your, people are always looking at their conviction in something they hold, right? And
Exactly.
they're always coming back and say, okay, would I buy this
Exactly.
again? And what you're saying is confirm that you're not willing to buy, or you still believe you
got it.
shouldn't own
You got
China.
it. Yep. And if you can't find good reasons that are incremental to those, then you need to think about how you might neutralize that risk position. And often when you see everyone else doing that in concert, you can see big drivers. Now, if the domestic consumer gets excited by price action and jumps in, then you're no doubt going back to numbers and narratives. You'll hear a narrative around the fact that there is $14 trillion or so, don't quote me exactly, it's a big number,
Yep.
in term deposits that could find their way into a market, into the stock market, and could drive further appreciation. So that's a big number. It's 2x, I think, the size of the SH comp, and the SH comp's free float's much smaller. So it's much bigger, that available share that can be bought from the public market. So anyway, that's enough on China.
So Gary, are there other areas that you're excited about that might seem a little contrarian?
There always are. Again, in the spirit of searching for the counterfactual, a couple of them are. I mean, so I won't talk about Japan, and I think it's quite well known that the Bank of Japan are looking at relieving their yield curve control. I think a lot of people have been focused on this for some time. I'm not sure that will be the catalytic event that some think it will be. I am more interested in questioning the narratives around Goldilocks, because I think the idea of everything being lovely ignores how that parable ends. So once Goldilocks goes in, eats all the porridge, breaks one of the chairs, soils the sheets, she ends up having to run for her life. And I just worry that may be a metaphor for the market in time when we look back on this period. But I wonder, linked to that, whether we talk about soft landing, but I wonder whether we've actually already landed and we're starting to re-accelerate. And a lot of the data seems to suggest there is some change. How sustainable that change will be, I'm not sure. But that is a question for markets, because if we are going to see back to rates, and what gravity was to the apple, rates are to valuation, and valuations are already quite high. If we don't see that rather aggressive move lower in the rates cycle from the Fed, then that will feed into valuations, and so that's a question for markets. More thematically, a few of the things that I'm really intrigued by is everyone. Have you heard of AI?
That's a new topic.
It's a big deal, I understand, but the perhaps even bigger deal is GLP-1 drugs and GIP drugs and thermogenesis and all these new things coming out of science. I mean, if you are going to read one book, I love The Economist, read that magazine, but read The New Scientist, because all of my ideas come from that, and they come much earlier than everything else. The New Scientist is just a brilliant read. But they've been talking a lot about some of the links they're seeing between these drugs and how they affect our reward networks, our reward systems in our brains. And we're seeing people that take them are drinking less, gambling less. And I'm wondering, sort of throw it out there, if we're all looking for dopamine hits, how this plays into social media. And, potentially could that impact, that muscle. So that's something to watch. I don't know where I'll find science or evidence for that, because it sort of just came to my mind. But that's of interest. The thing that's really caught me recently is digital gold. Now, everyone thinks that's Bitcoin. I think it might be gold. And I'll tell you why. I recently was invited very kindly by a friend to a conversation with the CEO of the World Gold Council. And in brief, what they are trying to do is galvanize support to create a data set of all gold globally and put it on a distributed ledger. Now, what does that do? Well, it brings gold into the 21st century in terms of governance. But it also provides provenance to gold, such that you remove a lot of the badder, the sort of the sadder aspects. A lot of mined gold still come from artisanal miners, and a lot of that gold is sold to nefarious actors like Wagner Group, for example, in Africa. So it could remove a lot of that. So good news, tick, governance, ESG, tick, tick, tick. But then he wants to create a digital token that's backed by gold. And I think this is fascinating, because if you listen to all the Bitcoin proponents, and I'm not betting up on Bitcoin, I think that's a scarce asset. There is a reason for that in terms of how you think about allocation. But all the reasons to own it is that it's transferable, it's divisible, it's available. And they were all the counter arguments to gold, because you couldn't break it up, you couldn't move it, and it's just hard. You couldn't send it to Tokyo from here. They disappear if you've got a token that's physically backed by gold. So I'm wondering whether gold's future is actually, it's been the longest currency. Its future could be in its past, and it could actually replace the thing that was meant to replace it, or at least not be broken as badly as the thing that was meant to break it, because they perhaps can coexist. But that to me was interesting. And to finish, I should have said this, but one of the lessons I always look for is search for anomalies. Anomaly is when something that shouldn't happen does, or something that should happen but doesn't, right? Gold's going up at the moment. It probably shouldn't be, because, the interest rate environment's actually tightening, not getting looser. And so that's curious, right? That's a trigger. So what's the counterfactual? And I'm wondering whether it's digital gold. You heard that here first.
Well, Gary, are there any other topics that you wanted to touch on with the audience today?
Well, I recently sold some shares in an AI stock, and I've been kicking myself ever since, because I obviously sold too early. And I sold it because I was sort of stricken by loss aversion from what happened in 2000. So I thought I'd seek someone who wasn't stricken by loss aversion. I reached out to young nephews of mine, and to get their view, because they were enclouded by all this stuff, and they were incredibly bullish, and rather annoyingly. And but he suggested I should read a book called The Cloud Revolution by Marc, I think it is. And it's quite interesting, because it talks, we all talk about AI is really exciting, and you've got these weight loss drugs, but there's other stuff going on. You've got distributed ledger, you've got what's happening with CRISPR technologies and gene editing, which they could be even more productive than some of this other stuff. And the idea of this book is that it brings together different technologies to create this productivity acceleration, much like we saw in the Roaring '20s. And I hate that language, because everyone goes, well, remember how that ended. But it's interesting, and again, I think it's part of the counterfactual for me, of my generation, who thinks all these things just end, to actually challenge that maybe we are at a start of something different. I'm not there yet. I haven't bought into this idea yet, but it's certainly on my mind, and I am sort of looking for signals as to question whether it's something I should explore further.
There's multiple general purpose technologies, right, that are coming together. So it's AI, the cloud, the gene editing, capability. These aren't they're not mutually exclusive.
Exactly.
Right? And
exactly.
What
they
we don't
feed
know
on
is
each other.
What's going to happen as they come together? What's on the other side of that?
Yeah, that is the challenge. I mean, I still think on AI we've got a little bit. I believe in the hype. I perhaps don't believe in the speed by which we get to that, that brave new world. And the reason I don't believe that is just from what I see from looking out my own window. For example, before we can train an AI, we need to solve the data challenge. Now, lots of firms have data challenges, right? Getting the data in the right place, in the right form, at the right time. And before we can solve that, I'm not sure, we're really going to exploit the opportunity set of AI. Sure, in some data sets that are static, that, it's there. Of course, there are going to be immediate benefits, but for lots of other areas, I think there's also regulation, which we don't talk perhaps enough about. You never talk about regulation in a hype cycle. Regulation is going to come back. You've got elections here in this country. So regulation is certainly going to be back on the media agenda, and it's going to be interesting to see how that plays out. So, yeah, I believe in the hype, but I'm just a wee bit cautious on the timing.
Thanks, Gary. Really appreciate you being here. Really interesting discussion. I know I learned a lot. I'm sure our audience learned a lot as well. And a big thank you to our listeners for joining us on Market Pulse by Faster Forward at Northern Trust Asset Servicing.